Very good afternoon. Yes, some background just and they could be begin with the presenter, please.
I'm on it. I was just waiting for you to join. You are presenter now. Afternoon, everybody. Okay, you can go ahead. I already started the recording and I've pasted the attendance register and evaluation form in the chat, and I'm sure they're just waiting for you because the assignment date was extended till today and they have a few questions, so I'll leave you. Good luck.
They don't, but it's fine. Thanks a lot. Thanks a lot, Claudine. Right, I definitely don't need to reintroduce myself. Many people already know me. previously we have done some nice recaps. Please note, already pasted for you to follow is the attendance register. So please kindly complete the attendance register for today's session. Today's session is focusing on general deductions and trading stock. So I will run through the theory, but at least today I'm hoping that we will be able. I just need to quickly mute. Yes, that's better now. So we will go through the deductions today. Last time we had completed gross income. I am hoping that the questions that we are going to do going forward are going to test the principles that we have already covered in terms of the gross income. So what I will do is I will quickly go through 103. So what we are covering today in terms of deductions, it's covered in your tutorial letter 103. And definitely the information on extension of assignment has been provided, but I don't believe you are part of the group that has not submitted the assignment. So we can immediately go through 103 today. So the specific focus, as I have said, sorry, I just need to mute the person. All right, thanks for muting. I quickly need to mute. Thank you, I've just muted. So please try to go through the attendance register. Roxanne, what I was saying is I am hoping that you are not part of the group who has not yet submitted the assignments that are due. That's what I wanted to reiterate. Other than that, please refer to the announcement made on your main Twitter page where you also receive emails. So I cannot respond to the due date specifically. There is a link where we can also speak to the lecturers, but the assignments as far as TAX2601 is concerned are due as previously discussed. So I do not want to touch much. I really wish that everyone can try to adhere to the assignments that were sent, and including the amended dates that were also discussed. So I want to quickly check these assignment dates. The first assignment was extended to be submitted by the 7th of September, assignment 2 before the 28th of September. As far as I'm concerned, nothing has changed, so we're still pushing to submitting assignment 2 on the 28th of September. I do note the holistical email that was sent out, but as far as TAX2601 for second semester is concerned, no announcement has been sent yet around the issue of the date of the extension. So we're still working towards the 28th of September up until there is an email that is provided. But quickly, without any further delay, we are just going to cover deductions. So basically, in your taxable income basic framework, this is your amounts that you are looking at. You are looking at gross income that we covered last week, per definition, specific inclusions. You're looking at exempt income. Then today we are going to cover general deductions, specific deductions, and prohibited deductions. So that's what we're mainly going to cover today. So like we deal with accounting, in accounting, you have something called an expenditure. So if you are doing your income statement, what they, in the revised terminology, it's now called statement of profit or loss and other comprehensive income. Your expenditure part, where you disclose your expenses. In terms of tax, for you to be able to claim an expenditure, a deduction, it must qualify as an allowable deduction in terms of the Income Tax Act. So what does it say? This says not all expenses may be allowed to go on as a deduction in terms of tax. So the accounting treatment and the tax treatment differs. Accounting looks at IFRS, tax looks at Income Tax Act. So in this case, we are looking at the income tax. So I want you to wear today a tax hat so that you can follow and move away from the accounting background. So from a tax perspective, as I've said, we are saying an expenditure, for it to be allowed, it must be allowed in terms of the Income Tax Act. So 5.2 focuses first on the general deduction formula. So the first thing that we look at in terms of the formula, in terms of the deduction, is the description or is the definition of how is general deductions defined. So one, we are saying that general deductions are allowed in determining a taxable framework from any person who is carrying on trade. So what we're going to look at, it is when you're looking at an expenditure, there must first be trade. So there must first be trade. So the whole definition of general deduction formula is covered mainly in your textbook. It's not covered in the study guide. It says general deductions in terms of section 11A. Section 11A, it's expenditure and losses actually incurred in the production of income, provided such expenditure and losses are not of a capital nature. So this is also read with section 23G, which looks at deductions that are not allowed. So these deductions that are not allowed can be listed as monies claimed as deduction from income derived from trade to the extent to which such money were not laid out for the purposes of trade. So section 11 looks at one requirement is that you must be trading. Second requirement is that the expenditure and losses must be actually incurred. So then the third one is it must be in the production of income, and such expenditure or losses must not be capital nature. So you are provided information as a legal background of how each component of the definition has been tested against court cases. So first we've got trade. So remember, for you to claim expenditure, you must be doing trade. So trade, it's a wide, it looks at a wide variety of things. So the case that was looked at was Badger's case versus the commissioner, where the principal was saying to be able to claim an amount under section 11A, which is general deduction formula, which says you must be trading, you must incur actual expenditure and losses. So it is necessary for the taxpayer to be carrying on trade. So this is, in simplicity, you must not have stopped your business. Your business must be a going concern. So expenditure and losses, please note that you have to keep on looking at your textbook for more information that has been provided. So in terms of your textbook, it says expenditure and losses refer not only to cash outflows, but to liabilities as well. So it's either it's in the form of cash or it is in the form of a liability. Payment can be made by issuing shares, land, or asset. So please always look at expenditure and losses, not from a cash point of view, but from what else can you provide as a token for the payment. So actually incurred looks at stores where the principle was tested. So what was the principle that was tested was for the expenditure to be considered as actually incurred, the expenditure must be unconditional. So if the money is not paid upfront, the accrual principle applied is it must be unconditional. There must be no possibility of a small print where it says you must not pay the amount. So it must be fully unconditional that the expenditure will be incurred. And then there's few examples that have been provided. We're going to touch on these principles again. It must be during the year of assessment. So you must only claim expenditure that has been incurred in the relevant year of assessment. Important part about expenditure, it must be in the production of income. So in this case of Port Elizabeth Electric Tramway, it was a case where the drivers were transporting goods from from Port Elizabeth to Johannesburg. They had an accident. The drivers passed away, and then the company paid the family, contributed to the funeral cost and all the costs related to the accident, mainly on the driver's side, paying the drivers as a compensation to the family. So they claimed that payment as a deduction, that expenditure. So the expenditure was actually incurred. Then the question that was tested was whether it was in the production of income. So the commissioner, of course, declined the initial calculation of a deduction when the return was submitted. So when the assessment came out, that amount was denied. And in terms of the principle, it was picked up that what was tested was the nature of the accident itself. Is it closely connected to the production of income? And what was found was the only way that Port Elizabeth PE Electric Tramway could have made money, it was to, of course, take the risk of transporting goods from one area to another. So it looks at that. So in terms of this case, they say it should be determined whether the task was necessary, whether an expected or foreseeable risk was attached to the task. So the task itself was closely connected to the production of income. So it may happen that sometimes that the expense is incurred to earn income or exempt income. In such a case, the expenditure must be apportioned. Only the portion relating to the income is deductible. Why I'm talking about this part here is because we are going to touch on this when we are covering restraint of trade. So if you are able to make notes on your side, please note that when we are covering restraint of trade, I need you to understand this principle. So the principle is very simple. It says if you happen to incur an expenditure to earn income, which is gross income, revenue income, and exempt income, an expenditure must be apportioned according to what is deductible and according to what is non-deductible. So when we're covering the issue of restraint of trade, please don't forget that. So an example has been made here to look at the principle as covered. It's something that you can be able to do. Then the issue of not of capital nature in the definition. Remember in gross income, We said not of a capital nature is tested by applying the objectivity and the subjectivity tests, which are also applied in the courts that look at the manner of acquisition, manner of disposal, the period in which you held an asset. But when it comes to a deduction, we look at different things. So we look at whether the expenditure has been incurred for income earning operations or for income earning structure of the business. So the test that gets looked at is the true nature of the transaction, closeness of the connection to the income earning operations or income earning structure. So when we are looking at income earning structure, it's when you are paying for buildings and machines. And when it is income earning operations, it is related to your operations. So we also look at the nature of business that has been carried on. So new state areas was the case where it's tested to test this principle. Expenditure is to be regarded as part of the cost of performing income earning operations. So that's basically it. So that is for section 11A. So the next thing that we cover is in terms of specific deductions. So specific deductions start with section 23B, which is double deductions. You are not allowed at all to have an expense deducted twice. An expense can only be deducted once. VAT portion, the VAT consequences are not dealt with in this module, but you just need to know that all figures that you will always deal with will always exclude VAT. Therefore, you don't need to make any adjustment. So legal expenses is provided in terms of section 11C. So remember, we're covering specific deductions. It's covered in terms of section 11C. So we're focusing on only legal expenses which are incurred for the production of income. So in order for illegal expense to qualify as a deduction, it must be in the respect of any claim, action, dispute in the course of carrying on trade, and it must not be capital in nature. So you've got an example provided. Restraint of trade, as I've discussed before, it's when someone gets paid for not competing with the same company. So in terms of the definition, it is payments that are not deductible in terms of section 11A because they are capital nature. However, in terms of section 11CA, the restraint of trade payments are allowed as a deduction only in respect of restraint of trade payments which are taxable in the hands of the recipient. So we're going to test these principles now when we are dealing with the question. So for you to be able to have a deduction, the following we are looking at that the amount must be actually incurred. So you must have actually made a payment. It must be in the course of carrying on trade. It must be a compensation in respect of any restraint of trade imposed only on natural person to the extent that the amount will constitute income of the person to whom it is paid, and the limit that you are allowed in terms of the deduction is you will take the deduction that it shall not exceed in any 1 year the lesser of the amount incurred divided by the number of years during which the restraint will apply. So it's 1/3 of the amount incurred. So we also have registration, acquisition, patents, and copyrights. So similarly, the deduction is only allowed if you are obtaining any patent, restoration, extension, registration, extension, and renewal of the registration of any trademark. So we're going to cover this and we're going to combine it again at a later stage when we're dealing with capital allowances. So please mark this part. We are going to be covering it more when we are covering the capital allowance as well, this part. Research and development expenditure. There's an example provided. It's there is some key important things that you have to look at. A deduction is allowed at 150%. The expenditure relating to research and development must be actually incurred, must be related to research that has happened in South Africa, in the production of income, in the carrying on of trade, and it must have been approved by the Minister of Science and Technology. And it must only be incurred after the approval has been provided. So bad debts, it's debts which we know that we are not hoping to recover anything. People have not been paying us for a long time, and therefore we provide a bad debt deduction. So remember, you can only claim a deduction as long as that particular amount which you are writing off as a debt was originally included in gross income. So this is the example that you are given here. For doubtful allowance, doubtful debtors, you only get an allowance from SARS of 25%, and it is applied on the list of doubtful debtors. It is applied on the list of doubtful debtors. So we'll cover that part as well. So a taxpayer can claim 40% of the debt for 120 days and 25% for debt that is older than 60 days. So this is covered in terms of Section 11J. Then we're looking at contributions made by an employer to pension, provident, and benefit funds. All of those become a deduction because it is incurred in the production of income. Any donations made to the public organization where a Section 18A receipt has been provided, you are only allowed to claim 10% of taxable income limit or the actual amount of the donation. So the important thing is this is covered as the last line when you are doing your taxable income calculation. Annuities paid to former employees on retirement. So the annuities are looked at in three ways. So it's either it's paid to former employees, to the dependents, or to former partners. So the one paid to former employees is deducted in full. The one paid to former employees and partners, so to the dependent of former employees and partners, it is also allowed to be claimed in full. The one paid to former partners, there are requirements for you to, before you allow a deduction. One, the amount paid must be to a partner that was at least having a service of 5 years, a retired partner. It must be in light of the services of the partner. It must be reasonable in light of the profits earned by the partnership in lieu of any other interest such as goodwill, and it must be genuine annuity. So we'll have examples. So prohibited expenditure deductions are in terms of Section 23. It is any insured losses, tax penalties, interest or on tax, provisions, expenses to produce exempt income, non-trade expenditure, restraint of trade payments, fines, and corrupt activities. So in short, losses would be, for example, if a taxpayer suffers a loss as a result of theft, which is deductible in terms of Section 11A, such loss will only be deducted to the extent that it is not recoverable by an insurance policy. So which means that you cannot benefit twice. You cannot have an income and from the insurance proceeds and also be able to claim the theft part of losing whatever value of stock, if, for example, that you have lost. Tax penalties, and interest relates to any penalties or interest that you may pay to SARS as a result of what is considered to be negligence. It is not allowed. Provisions, expenses, and as well as restraint of trade. Restraint of trade, we have already provided for that. Is to be deducted over the period of restraint agreement or 3 years, whichever is longer. But we're going to deal with these examples. Prepaid expenses, similarly, I want to break it down to you. You may as well as be able to read in terms of the limit of prepaid expenditure. Remember, prepaid expenditure is an expenditure made in advance. So the prepaid expenditure can only be allowed as a deduction if it falls within 6 months, or if the aggregate amount of all prepaid amounts is less than 100,000. So there's an example provided for that. Then we move on to trading stock. So the important thing about trading stock is we're going to do now an example where we're going to apply a section 22 that provides that closing stock is income in your hands. It becomes gross income. Opening stock is deductible in your hands, specifically because the period economic value or economic life of trading stock is considered to be 12 months. Therefore, after the following year, that opening stock is considered to be deductible. So they give more example around opening. Stock acquired for no consideration. So if it's private and domestic consumption, therefore, how do you take it up in your book? So you take it up in terms of the market value. So we will cover a nice example that I just want us to cover and be able to finish. So we're going to do, sorry. We're going to quickly cover 5.2. I just want you to quickly read 5.2, Tweezers Pty Ltd, and then we can quickly open in Excel and cover this question. So I'm just going to give you a few minutes to study question 5.2. And then we immediately going to try and do a quick solution. So please quickly read 5.2. It's on page of your study guide, page 22. Please, for those who just came in now, please remember to complete the attendance. And then I will be with you just now. Please read that 5.2. Then in the next 3 minutes, we'll just start again. Oh, sorry, I'm currently on mute. That's actually not intended. I don't know how I got to be on mute. Apologies for that. So we have read the required, and we have seen that the taxable income for the company is 1,410,000, and this it's given. So we have went on and we have captured this amount. So we are looking at the next, where we are provided the following transactions that were not taken into account. So we are given that the following legal costs were incurred during the year of assessment: legal costs relating to the collection of long outstanding debtors to the amount of 5,677, cost to draw up a lease contract amounting to 2,800 for a lease period of 10 years, and Twizzers is a lessee. So the question is the 5,677 deductible?
I think yes.
What would be your reason? What would be your reason?
I said according to section A, 11A, ne? What did I read there? 11A. I've now moved on to something else. Sorry. Because it's an expense that's incurred in a collection of debtors, it's something, I forgot what's the right wording, but it's under section 11A. I'm gonna try find it.
Which means that incurred in the process of trade and in the production of income. So that's why that 5,677 is allowed. The 2,800, is it allowed?
No, it's not.
Why?
Because in section 11A, it's one of the first, like, so there's ones that are not allowed. It's mentioned that the expense, so for example, the expense of the lease would not be allowed to be claimed.
So for those who need to refer to this, please refer to this amount is capital in nature. So what happens is when you are calculating the lease liability and the amount to recognize for your right of use of an asset, one of the amounts that you capitalize into your right of use of an asset is the lease amount that you have paid relating to the cost to draw up a contract. So they call them legal costs. They get capitalized in terms of IFRS in principles. Therefore, that amount is not allowed. So the second one, we are told that court representations and witness fees arising from a court case which was settled during June 2019. Twizzers was ordered to pay damages to a client after the client's child accidentally contracted food poison from the product owing to negligence during the manufacturing process. The legal fees amounted to 40,000. Is this deductible? Anyone?
Okay, I think it's not deductible.
Yes. You know what I'm gonna say next?
Yes. Everything keeps on going back to 11A. Well, according to what I read, it says that the ones that are not allowed to be deducted is court fees is mentioned there. So that's why
this one, remember, this one is not court fees. It is legal costs. We are looking at the legal costs which you paid to represent for the for the legal attorneys to represent you in court. So that's what we are looking at here. We're not looking at the amount that was settled. We're looking at the legal cost that just got incurred, not the amount that was paid to settle. So so what do we say?
So if that's the case, I would then say it should be claimed then because it's in respect of an action or a claim. So it should be claimed. If I'm understanding well, still under 11A. So the ones that says which costs must.
No, I understand you, but you must not look at it from that point of view. So how we must look at it is, the first thing that we look at is in terms of section 11A. This is deduction. It's actually incurred. It was in the carrying on of trade when we were selling that someone who bought our product contracted food poisoning. So in the manufacturing of the sweets that we are doing, someone incurred food poisoning. Now the question becomes, is the 40,000 incurred in the production of income? And the answer becomes no. It's not incurred in the production of income. That's just one of the parts. The second one is the issue of negligence. So had we been more careful in terms of us trading, we would have had this problem would have not have happened. So in this particular case, this negligence part, because of the negligence, so it's two things. It's damages claimed for legal costs. So what we are looking at is trade negligence. So negligence becomes the biggest word. Is negligence. So it could have been avoided, but it was not avoided. So it's the key word there is negligence. Had we not been negligent, would not have had this issue. So it's mainly because of negligence that now we are seeing ourselves now having to not allow this amount as a deduction. It's mainly because of negligence, and SARS does not provide a deduction when negligence can be proven. So that's the main reason why this 40,000 is not allowed. So we jump to number two. Number two looks at the invention to be used in the business was developed during the year of assessment. Following an extensive research, expenses for the development after 1 May amounted to 68,000. The company received no external funding for the research. Approval was obtained from the minister as well as the Department of Science and Technology for the development of the invention program on 1 May 2019. Are we going to allow this deduction? Research and development cost? Yes, I'm listening.
Yes, we're going to, but I'm trying to figure out where it is, what's the.
I hope you are looking in your. In your text. Yes. But these are the things that we are looking at. Firstly, is that expenditure must be actually incurred. Two, research must be in South Africa. Three, it must have been approved by the minister. Sorry about that. I just want to quickly write them as nicely. It must be in the production of income that we pursued this research. It must be whilst we were carrying on trade it must be approved by Minister of Science and Technology and Expenditure incurred on or after date of approval by Department of Science and Technology. So those are the things that we look at in terms of research and development cost. So in this particular in this particular case, the question becomes, does this meet all those? So one, we did pay 68,000, despite us not being told where the research was done, but there is nothing that mentions that this was done overseas, because the rands as well, the currency of the money is in rands. Approval was obtained from the minister and the department on 1 May, and the expenses after 1 May were also 68,000. So we assume that the 68,000 was on the day. Now the difference becomes the amount that you allow as a deduction becomes 150%. So which means you are now allowed 102,000 of the expenditure. So we move on. We look what else must we cover. So you've got a trademark. So GIZZ was purchased on 1 January 2020. Remember, if the year of assessment is 31st March, it means that I just want to quickly make the start date and the. So it means that our year started on the 1st April 2019 and ended on 31st March 2020. So 1 January for this trademark would have been in the current year. The expected useful life of the trademark was 8 years. On 1 December, the company also renewed the registration period for Wiz trademark for another 5 years at a cost of 3,000. So we've got trademark GIZZ. So GIZZ, we are purchasing a new trademark. So here, this is not deductible because it is capital in nature. So it's not allowed. Because it is capital in nature. But in any case, any trademark purchased, any trademark purchase is always not deductible. So we look at the second one. The second one is with. This is renewal. So whenever we get anything that has to do with renewal, renewal is immediately allowed as a deduction, and we pay 3,000. So please don't forget this sign. A deduction must always be indicated by a minus. So this is renewal. Then we look at the next one. The next one is please, I would like to claim bad debts and doubtful debt allowance. So the important word, please note, doubtful debt allowance. So the accountant prepared a list of doubtful debts where debtors are older than 60 days, but not more than 120 days at year end. Tweezers does not apply IFRS 9, and the company claimed doubtful debt allowance in the previous year of assessment. So here we are provided a data statistics where as follows: bad debts recovered. For 2020, we don't have anything. We've got a list of doubtful debts at year end, all greater than 60 days, but less than 120 days. So you've got your amounts. Debtors at year end before bad debts were deducted. This is your receivables. Bad debts for the past 2 years. You've got 4,600 and you've got 12,000. So this is bad debts that we have in the current year. So we have also the statement that says a data. So we've got this as well relating to 2020. This 10,000 for list of doubtful. So we are told that a data fees pop CC was placed in liquidation during January 2020. Fees pop CC paid its creditors 50 cents in the rand. Fees pop CC debt owing to tweezers at year end amounted to 60,000. The amount is not included in the above bad debts or list of doubtful debts for 2020. So we've got bad debts. So all we do in terms of bad debts is we first have 12,000, and then we've got 16,000, which we need to multiply by 50 cents. And then basically this becomes our bad debt. So it's 12,000 plus 16,000 multiplied by 50 cents, which gives you 20,000. Sorry, everything must be negative. 20,000. Then we've got doubtful debt allowance that we must now allow as a deduction and an income. So we will consider 2019 and then we'll consider 2020. So for 2019, you are given list of doubtful debts. And you are told that the list of doubtful debts is 16,000 and the list of 2020 is 10,000. So remember, we are told here that all debts are older than 60 days, but not older than 120,000. So in terms of IFRS 9, you can claim 40% on debts that are more than 120 days. So in this case, it means that we can claim only here both 25%. So the 25% will be applied to the list of doubtful debts. So in the past year, we had list of doubtful debts of 16,000. So what does this mean? This means that we 16,000. This is what we allowed in the previous year. We allowed a deduction of 16,000 multiplied by 25%, which was 4,000. In the current year, it's 10,000, so it becomes 10,000 multiplied by 25%. So it becomes 10,000 multiplied by 25%, which gives you 2,500. Now, this is what I want you to get. In the previous year, you were given a deduction of 4,000. In the current year, that deduction becomes a positive so that you can only allow a deduction for the current year doubtful debt allowance. So in terms of Section 11J, the doubtful debt allowance provided in the previous year must be added back in the taxpayer's income. So, because remember here we are dealing with doubtful. We're not saying bad debts, we're dealing with doubtful. So we proceed. Then we've got dividends to the amount of 20,000 were distributed to the only shareholder, Mr. Weiss, and the salary of 180,000 was paid to him. So here we've got dividends. Dividends they are not a deduction, so we're not going to do anything. Not a deduction. They do not come from normal business of the or normal operations of the business, and therefore salary paid, we expense it at 180,000, and then we will have our total of 1,460,000. Sorry, my salaries must be actually a minus of 1,100,823 becomes your taxable income. Remember, you were asked to calculate your tax liability, which is going to be at 28%. So you're going to say this amount multiplied by 28%, which gives you 308, 230, 44, and that becomes your tax liability. Number 6 tells you that the provisional payments made for the 2020 year of assessment already amounted to 100,000, so you say less provisional. Tax payments already made in the current year of 100,000.
Do not touch those glasses. Someone can't fetch them.
All right, Tikeledi is muted. Right. So then this means that your tax liability so tax payable on the income at 28%, tax liability therefore will be 308 minus 100,000, which gives you 208 to 130. This becomes your tax liability, what we want to achieve. So what I'm going to do is I'm going to focus then on the next question as well. I'm going to ignore the gross income. So in this question, you will note that you are also asked to calculate taxable income. But I want to only focus on what we have not done. So in terms of question 5.3, I'm not going to do the whole thing. I'm going to only focus on what we have not yet done. So we are not going to try and do the whole thing. We're going to only focus on what we have never done before. So initially we've got gross income. So we asked to calculate taxable income. We are not asked in this question to provide any reasons why we are not excluding, but we might also get to that part of maybe providing reasons. We don't know, but maybe let us quickly start. So we've got gross income, very straightforward. But the value, right? We've got gross income, which has been given as 4,590,000. So we're quickly going to read the following things that are provided. They say we are in the cell phone industry. It has an extensive customer base. The current financial year is 30 June. So this means that the year would have started on the 1st of July 2018. The following activities that happened in the current financial year, you've got gross income already. So Blue's employees belong to a company's pension fund, medical aid fund. Blueberry contributes to these funds on behalf of the employees during the year, contribution on behalf of the employees to the pension fund. So we've got pension fund. We are told that it's 110,000, so we take it as it is, 110,000. We have, and to the medical aid, 135,000. Medical aid becomes 135,000. We are told that there was also salaries of 2,350,000 incurred. So no questions asked. Salaries, they go exactly as 2,350,000. We look next. The financial manager, Mr. Gray, resigned on the 1st of June 2019 to prohibit him from trading in direct competition to Blueberry. The company paid him an amount of 550 as compensation for his restraint of trade for the following years. The full amount was included in Mr. Gray's income for his 2020 income tax return. So this is what I want you to remember. And we've been told that portion of this amount is not taxable. The deduction would have been limited to what is taxable in the hands of Mr. Gray. So in this case now, we have to calculate the restraint of trade deduction. So what is the limits that we have to look at when we are calculating this amount? It is the lesser of, so we are told that 550,000 was paid. So we're looking at two options. Remember, it is the lesser of 550,000 divided by 5 years, or 550,000 divided by 3 years. So it's the lesser of this is the key word. So restraint of trade, it's the lesser of. So which one would be less in these two scenarios? So if you are using your calculator, you will see that you've got 110,000, and for 550 divided by 3 years, how much do you have? Anyone?
It's 183,333.
So which one is lesser?
5 years.
The 5 years.
5 years.
So the lesser becomes 110,000. So that is what is allowed. But remember, the key thing is the payment that is allowed as a deduction is only looked to the extent of what is taxable in the hands of the person to whom the payment was made. So first thing, it must be made to a natural person. Secondly, that amount must be fully included and taxable in the hands of the beneficiary. So in this case, that's how we got to this amount. So the debtors clerk indicated that the list of doubtful debts amounted to 2,200,000 at the end of the year. Of the total list of doubtful debts, 500 relates to debtors older than 120 days, and the rest relates to debtors older than 60 days but less than 120 days. So very important that you note this information that I'm highlighting. Blueberry does not apply IFRS 9. The doubtful debt allowance claimed in the 2019 year of assessment amounted to 760,000. So doubtful debt allowance. So we are in 2018, 2019. So we'll first look at 2018. 2018 has been given, and it has been given to us as an allowance. So we are told here that the debt allowance claimed, not the list of debtors, but an allowance claimed is 760,000. Please note the wording. So 2019, what happens in 2019? 2019 means you have to first take the first 500,000 and multiply it by 40% for those debtors that are older than 40 days. So this is older than 120 days. And the second one would be 1,700. Sorry, just want to do something so that you can follow this. So 2019, we are provided with a list of doubtful debts amounting to 2,200,000. That's the correct, yeah, 2,200,000. So you are told that 500 days relates to debtors older than 120 days. So this simply means the 500,000 is divided by, is multiplied by 40%, which means that you can only claim an allowance of 200,000. Sorry, okay. The second one becomes a difference. So the difference between 500 and 2,200 becomes 1,700. So it becomes 1,700,000 multiplied by 40%. This is for older than 60, less than 120 days. And here we say yes.
But then shouldn't it be 25%? So how do we know when it's, I thought when it's 60 days, it's 25%.
That's why I am giving you what the Act is saying.
Oh.
The Act says, when your debtors that are outstanding, in terms of the list of doubtful debtors, if they are outstanding for more than 120 days, then you can claim 40% of an allowance.
That I understand. Okay. Yes.
If they are older than 60 days but less than 120 days, you can only claim 25%.
Oh, yes, that's what I was asking. Okay, fine.
Right. No, sorry, maybe I had it wrong as well on my side.
Thanks.
So 2018 is given. So Legal fees to the amount of 140,000 were incurred for the following: collection of outstanding debtors. So legal costs for debtors, it becomes obvious by now. 85,000. Then the second one becomes a court case in respect of employee remuneration claims. They say note employee remuneration is deductible for the purposes of this question. So then it becomes a straightforward thing, because we had to go to court because employees were demanding an increase. Therefore, for us to have been represented there, we incurred legal costs. Therefore, these legal costs are deductible as well. Penalties and interest. Penalties and interest. This is where Section 23 says this is prohibited deductions. So these become prohibited deductions. Therefore, they are not allowed. So when something is not allowed, you don't even enter it. So that 16,000, you don't enter it, it becomes a nil. So you do not consider it. So you've got also bad debts written off. You've got loan to director, and then you've got trade debtors. So for trade debtors, I don't even want us to debate. It's straightforward. It's 122,000. Loan to the director. I know most of you by now would say they are not sure whether it is taxable or not, but I just want to hear from you. Is loan to a director deductible in terms of the Income Tax Act?
No, it is not deductible. It is not initially included in our gross income.
Remember, this is a loan to a director. So it's not how the sales amount was made in terms of the gross income. The second one, trade debtors, we have already made an income before and were taxed higher because SARS thought because of the accrual principle. If you remember the definition of gross income, total amount in cash or otherwise, accruing to in favor of received by in the year of assessment, not of capital nature. So you would have this money would have accrued to you, but now you have written it off. So it was initially included, but loan to a director not included previously in gross income. So it has never been included. Then the following prepaid expenditure on 29th June. So we've got prepaid expenditure. So remember, the principles for prepaid expenditure is two things that we look at. So if it is less than, so you look at whether it is less than 6 months after a year of assessment, or aggregate prepaid amounts less than 100,000. So this is the principle of prepaid expenditure. So let us go read what we have. The following prepaid expenditure was incurred on 39 June. Remember, this is the last day of the year of assessment. Rental for the switchboard system for the head office for a period from 1 July to 31 January 2020 amounted to 40,000. Deposit for the purchase of a delivery vehicle that will be delivered on 1 September 2019 amounted to 85,000. So we've got switchboard, and then we've got delivery vehicle. So delivery vehicle, one can pick up already that the delivery vehicle in this case is capital in nature because it is an asset to our business. Therefore, it is capital in nature. So it's expenditure that was incurred for structured for producing future structured income. So the capital nature, we have tested it. It's actually where we have expense and an amount, but it was for capital purposes. It was not for revenue purposes. So it was not for income earning purposes. It was mainly for creating a capital asset. So in this case, the switchboard, we look at these two things. Is it less than 6 months? So it paid from 1 July to 31 January 2020. So does it meet the 6 months?
Yes, 7 months.
That's 7 months. So it does not meet the first one. But the second one says aggregate prepaid amount must be less than 100,000, and this amount is 40,000. So we can include all of it as 40,000. Any questions? Any questions?
Mr. Mbisi, can I ask something on the salaries? Are we adding them?
No, I've seen that mistake. They are a deduction.
Okay.
The salaries are a deduction. I've spotted that mistake on my side. They are a deduction. So we've got gross income, pension fund, salaries. So we've got this 110,000. We've got 760. We've got this 625. We've got 85, 55. We've got this 122. We've got 40,000. There is just a formula issue, but it's fine. I can always work around it. Right, that's the final amount. So I quickly want to look at 5.4. 5.4, I want to look at things that we have not yet done, only those that we have not ever done. So we're not going to cover everything. It's only those that we've never done. So 5.4, its beauty is a business manufacturer of jewelry. It's the same question. So you are given here a taxable income and you are asked an annuity to a dependent of a retired employee. So this 120 becomes fully deductible. So we're only focusing on deductions. So an annuity in this case becomes fully deductible. As 180,000. Legal expenses and everything, the information is provided. So legal expenses for labor negotiation. So legal costs for labor negotiations. This meets the definition of Section 11C and Section 11A, so you can provide for 20,000. Legal appeal to SARS regarding imposed tax. What does everyone think? Is it allowed? Legal appeal to SARS? Mhm. This amount is not allowed. It is prohibited. So it is not allowed. So then we have got bad debts of 45,000. So we've got trade debtors and loan to an employee to buy a motor vehicle. So the 20,000 would not be allowed. So I'm not going to do this one. Only trade debtors are allowed. The loan to employee has never been included in gross income, so we don't focus on that. The next one becomes the list of debtors at year end is an amount of 22,000 that is considered doubtful. The debtor is 90 days old. The doubtful debt allowance that was claimed for 2019 is 3,750. So doubtful debts, it's given 3,750. We're adding it back. So how do you calculate 2020? Anyone? Is it 25% or is it 40% for 2020?
25%.
So it becomes 25%. So it becomes, you've got list of debtors of 22,000. So it becomes 22,000 multiplied by 25%. It gives you 5,500. And that 5,500 is negative. So it becomes a deduction. So restraint of trade is the next one. The managing director decided to take early retirement. Subsequently, the company paid him an amount of 200,000, restraining him from doing the same business after 2 years. So remember, restraint of trade is two ways. So we're gonna say 200,000 divided by 3, or 200,000 divided by 2. So which one is lesser? So which one becomes lesser?
Divided by 3.
So divide by 3.
Right, divided by 3 becomes 66,667. Then we move on. Beauty paid an annual insurance premium of 50,000 for the period from 1 January to 31 December 2020. So we've got here, what is our year end? 31 March. This was paid from 1 January 2020 to 31st December 2020. So this means that we're gonna have insurance premium from 1 Jan to 31st March, which is going to be 3 divided, what is the full period covered by this amount? 12 months, right? Is the 50,000 for 12 months? Can anyone see what I just did?
Yes.
So you first take out what is relating to the current year. So the prepaid amount is going to be then equal to, prepaid amount is then going to be 50,000 minus 12,500, which is going to be equal to 37,500. So this becomes the prepaid amount. So remember, the principle here is we are looking at whether it is 6 months after year of assessment or aggregate total prepaid less than 100,000. So this is what we are looking at. And in this case, it is 37,500. Therefore, it is less than 100,000. Is everyone feeling comfortable? So the only thing that we did not cover is the issue of trading stock. So the important thing that I really want you to do is to do the examples that have been provided, where there's been a stock that has been purchased, but I can as well as quickly share a question that we can do, which was in your study guides previously. So I'm just quickly going to share this question so that we can just tackle the issue of trading stock. So this becomes our last question. Please do not forget to complete the attendance register. For those that will be leaving soon, let me just quickly share the link to the attendance register and also share the link to an evaluation form. Right, so let us quickly look at this question. This is question 5.5, which was there previously. I'm not sure why it's not there now. So this question looks at Valley Jeans Pty Ltd, manufactures and sells fashionable jeans and jackets. The company's financial year is 31 March. The following information has not been dealt with by the accountant. You are given your sales is 7,550. Then you are told that the manufacturing and acquisition cost of stock during the year amounted to 3,500,000. The closing stock, you are given the value, and then you are given the value for jackets, you are given the value for t-shirts, and then the question asks you to calculate the taxable income of Valley Jeans. So I am quickly going to try and do this question with you. I know that I just lost now the sharing facility, but will be I will quickly share back just now. So I want us just to quickly do this question. I'm just going to share it again. So we are asked to do taxable income of Valley Jeans. So this is just to test the trading stock part. So we are given the sales. Sorry. So we are given sales. We just need to have these two columns to enable us to be able to calculate trading stock. So we've been given sales at 7,500,000. I'm going to just unpack now So we are told that the manufacturing and acquisition stock during the year of assessment. So this becomes an obvious deduction. It's manufacturing. And purchase cost. And you are told that this is 3.5 million. Right, let us now get to the gist of things. So you are told here that we've got a closing stock. The closing stock, remember, it becomes income in the hands of the taxpayer. So the following costs were incurred in respect of manufactured jeans. Stock on hand on 31st March 2019. And not disposed as counted and calculated by the auditors at 5 o'clock. These costs have already been included in 3.5 million. So direct materials and labor, it's 1,900. So manufacturing machine bonus. And then you are told that on the evening of the 31st March, there was a heavy storm. Roof on one of the storerooms leaked onto some of the jeans and caused damage to these items to the amount of 250,000. So quickly want to quickly put on all these costs. So we've got direct materials and labor, which is 1,900,000. We've got 400,000 of maintenance of machines. Please note, this is manufacturing. This is all in the manufacturing. And then we've got bonus for a marketing manager. And then we've got damage, jeans. So that 500,000 that was incurred for a marketing manager, one can already pick up that it's not even in the manufacturing environment. So we take it out. Damaged jeans of 250,000. These are included in the closing stock. So because they are supposed not to be included, we therefore are going to take them out. So this simply means that all these amounts are therefore going to make a closing stock, which is sum of all these three amounts, making up 2,050,000. So closing stock, this is related to jeans. This becomes a positive in the hands of the taxpayer because it's already included as a deduction under manufacturing. So we've got jackets. We are told that Valley bought blue jackets from an agent in Cape Town. The cost incurred in acquiring these items is 800,000. So we've got jackets. Cost is straightforward, 800,000. It's money. The transport cost of 10,000 also paid to get the stock to Johannesburg. So transport cost, remember, in terms of IAS 2, it says that all costs incurred to bring an asset to the condition and location intended by management are included, all costs. So both the expenses are incurred in the manufacturing and acquisition of 3.5 million above. During SA Fashion Week, the company was shocked to discover that there had been a sudden change in fashion. Blue jackets are now out of order and only black jackets are in demand. Valley estimates the value of jacket has now diminished by 600,000 as a result of unforeseen circumstances. None of these blue jackets had been sold at year end. So this simply means because now of a change in fashion, we have now put on big sales for customers to see the sales that we have made, and this means that this closing stock is losing now a value of 600,000. Therefore, the cost of all jacket becomes, because this is closing stock, remember, jackets, it's closing stock, it's 210,000 becomes positive. So we're looking at t-shirts now. T-shirts, CEO of Valid Jeans Pty Ltd, GP, has a brother, Pololo, who owned a clothing shop. Pololo closed down his business in January 2018 and donated all of his t-shirts to Valley Jeans Pty Ltd. Pololo acquired the t-shirts at a cost of 300,000, but the market value at the date of donation was 200,000. None of these t-shirts had been sold at year end. The closing stock value accounted for at year end for the previous year for tax purposes was 955,000. So this becomes opening stock. We have a deduction of 955,000. So quickly, we have donated t-shirts as a company to a brother who owns a local shop. The cost of the t-shirts were 200,000, were 300,000, but the market value was 200,000. So what value are we going to include in terms of this donation?
300,000.
Why 300,000? Remember, you have given them to your brother. You have never sold. You've not sold them. So 300,000 is what you bought them at.
The donation is 200,000.
All right. Before people start to guess, but I'm waiting for one who will just come up with a straightforward answer. So in this case, what has happened is we have disposed, in simple language, we have disposed of these t-shirts, or we have given them as a donation. So we have given these donations to a natural person. If it was a public benefit organization, it would have been exempted. So sorry, we would have had a donation that would have to reduce after taxable income. But because now we have donated them to a natural person, we are donating them at market value because we are disposing trading stock for no consideration. Do we understand? The donation will be at market value in terms of Section 22 because we are disposing of an asset, but to a natural person. So if we are disposing to a natural person, the value at which we are donating would be considered to be market value. Remember, we are not making profit. If we were making profit, we would have wanted to recover 300,000. But in this case, we are not making profit. Therefore, donations would be at market value because we have given over to a family person. So this becomes 200,000. Initially, when you purchased, the cost, the 300 cost was included here on purchase cost. But here you have donated. So the donation is at 200,000. So if anyone can pick up, this simple means that you are still losing 100,000, which will remain taxable. So only the 200,000 doesn't get taxed. I mean, only the 100,000, but the 200,000 gets to be taxed. Can we pick up that?
Yes.
All right, that takes us to the end
Sorry,
of
sir,
today.
can I ask?
Yes.
Between Pololo and Vale, who's donating? I think maybe there's a misunderstanding there.
So GP, on behalf of this company, which is Valley Jeans, donate to Pololo, a brother to him. So JP is a donor and Pololo is a beneficiary. So in this case, the t-shirts that were already, because these t-shirts already cost already included in purchase costs of 300,000, to which the 350,000 here has been allowed as a deduction. But because you have given up donations, you have given up your t-shirt as a donation. When SARS thought you were trading, that's why they gave you a deduction of 350,000. So we are now adding this donation back as an income, so as a positive, so that you are only allowed the 100,000 difference as a deduction, but the 200,000 is taken back as an income. So it's recovered back by SARS. That's why it's included as a positive. Any other questions? Right. So that basically covers.
Mr. Sorry, Mr. Please.
Yes.
My question is, if it was not donated to a brother, it was donated to the organization, it was gonna be a negative.
If it was donated, it was going to remain negative here, but then under taxable income, we were going to have the donations here. If specifically if there is a section 18A certificate. So we were gonna say the donations are limited to 10% of taxable income or actual donation. So in this case, actual donation would have been the cost of 350,000. Can we follow that part?
I'm getting lost. 350,000. How then?
So it's 300,000, not 350,000, 300,000. Because remember, the donations are limited to the amount that is recouped, that has already been provided as a tax benefit to you. No, sorry, why am I confusing myself here? If we were looking at donations to a public, sorry, I don't even want to give this example under the donations part. Sorry about that. If this T-shirts were donated to a public benefit organization, then the amount here that you would add back is the full 300,000, which is the cost. The full 300,000 would be the cost. But because you are donating to someone else, you are only getting a benefit of 200,000 at market value. But if it was public benefit organization, you would fully receive a full recoupment in terms of the deduction that was provided before. Can you follow that part?
Yes.
So that's how it would work then, Dikeledi. You would have to deduct the full 300,000, but because it was donated to another person who is a natural person, no. Dikeledi, I think you caught up to me. Correct. You are correct what you were asking. The person who is donating this to us is Pololo. Sorry, I read this thing incorrectly. Sorry, I definitely read this whole thing incorrectly. Sorry, apologies, guys, for that. I missed that part. I read very quickly, and I hope you can see mistakes that can happen in an exam. Pololo closed down his business in January 2018 and donated all his T-shirts to Valley Ltd. So, which means we have this. We have acquired these T-shirts at no value. Can anyone pick up that? Because these were donated to us. So we have acquired these T-shirts at no value to us. I think I must highlight that yellow. So the donations, because we did not spend the 300,000, it's Pololo that spent that money. We will take only the market value of the donation at year end, which is 200,000, which becomes now the closing stock in our books. So it becomes income that we can be able to sell in the near future. Sorry, I missed it as well. I quickly read that part, so I missed it. So that's basically how you do it. So it has nothing to do with private benefit organization. If stock is donated to you at no value, if it's acquired to you at no consideration, so it is always first, if it's still on hand, we first look at market value. So we look at the market value because that's, you did not incur any money for that particular stock. So it does not matter who donated it, you will always take it up in your books at market value. Does that now cover you, Dikeledi?
Yes, Mr. Mpisi.
All right, no, I'm glad. Any other questions? All right, if there is no other questions, next week we'll be covering capital allowances. As we are covering capital allowances, please prepare yourselves. It will be same time on Tuesday. We will cover capital allowances and keep on studying. make sure that next week, Tuesday, you have completed assignment 2. I know that no, by Monday, make sure that you have submitted it. I know that I'm lagging behind in terms of the assignments, but I'm hoping that we can be able to complete capital allowances next week and then start with capital gains. But I'm doing each learning unit very slowly and thoroughly so that you can already understand everything. So Viseka, I'm going to share the page on the notes on my UNISA that we covered for this particular question. And I'll also post the solutions that we did for today. So that will cover you as well. So thank you very much for attending today. See you again on the 29th of September at 4 o'clock. I will remain for a few hours to take up any questions if you may have. And then soon after a few hours, then I will also leave the call on Microsoft Teams. Thank you very much. Please don't forget to complete the attendance and don't forget to complete the feedback evaluation form.